Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome back our friend Martin North. How are you, Martin?
Very good, Alex. How are you?
Pretty good, thank you, and welcome back. And you've been busy at Digital Finance Analytics going over all these data points, and we wanted to have this monthly update for viewers at home to talk about top 10 data points or trends. And as you said to me in the pre-interview, they're slightly different data points this month, but that's because you believe they tell the story.
That's right. Yeah. So, we run a whole bunch of analytics and collect a whole bunch of information, but because of different timings and different dimensions, I think it's best to focus on the ones that tell the story the best rather than rigidly sticking to, just 10 slides we always show. So there'll be a lot of commonality, but I think at the margins we'll tweak it a little bit.
Yeah, and for anyone at home that's wondering, what are the seasonal differences that we normally expect around Christmas time and that festive period? It tends to be less houses sold or people spending more money on certain things. Or what would you say are just the general trends before we dive into these top 10 data points?
Well, yeah. So certainly over the Christmas period, home sales drop away to almost nothing. There are no auctions for 3 or 4 weeks. Number of listings normally go down. Everyone's focusing on, the sand and the sun and Christmas and New Year and those things. The retail trends, which won't come out for another month or so, for December, will be quite important. But the November trend came out today, in fact, and was actually quite strong on a season-adjusted basis. And that was because a lot of people did their Christmas shopping in November, and a lot online, by the way. So there's a bit of a pivot in terms of household consumption, which we'll touch on with the data. But then the home price data and the home sales data begins to ramp up towards the end of January. And then the autumn season, really, with January and February and March, will, I think, tell the tale of probably through the year.
Exactly. So let's dive into it. The first one you've got for us, which will appear on screen for everyone at home, is housing credit. And there's a few different categories to dive into here as well.
Yeah, so this is from the Reserve Bank monthly data, and they give you an annualized growth by different categories. So the thing to understand is that, it's really disaggregation that's important. So the overall number isn't that useful, but housing credit overall is still growing at 4.9%. Now, it's come down a little, but 4.9% is still well above inflation, still well above wages growth. So all of this talk about there's no lending going on is actually wrong. There is still plenty of lending going on. It's just that the rate of growth is slowing a little. Now, within that, owner-occupied lending growth is going on at 6.8% growth year on year. Now that's 2 or 3 times inflation, right? So don't go away from this sort of message saying there's no credit growth. There's plenty of credit growth. What of course has crashed is the investment lending, so that's down to 1.1% growth. And the other piece of data there is the business lending, which is moving up a little, but not enough to overtake housing credit. So overall, the takeaway is yes, credit is slowing a little. But housing lending is still significantly above the sort of the long-term expectations that you might have. And therefore, when the Treasurer says, well, the banks aren't lending, well, actually, the banks are still lending. It's just they're not lending quite as much as they used to.
Yeah, and that point is important to keep in the back of your minds as well for the viewers at home. As we move through these other categories and talk about what else is happening, the fact that that is still growing as well. And the next one is that household confidence. And there's actually been a notable uptick in one sector that I'll let you touch on as well.
Yeah, so this is basically from our own survey data. So we ask households about how they're feeling from a financial perspective vis-a-vis a year ago. And one of the ways that we separate it is from those who have property but no mortgages. So we call those the free affluent. They're the people who actually probably will have more assets and will not have a mortgage. And they are still slightly more confident than the long-term average. The long-term average on the index is 100, right? So they are above that, but they are continuing to move down. And that's driven by things like the stock market, share market gyrations recently, lower rates on deposits, and just some of the broader economic uncertainty. Then we've got those people who are owning property with a mortgage, okay? And that could be investors or they could be owner-occupied borrowers. And we've seen there a considerable dive to below 100%. And that's being driven by significant drops in home prices, but also at the margin, mortgage rates rising. In fact, the Bank of Queensland lifted their rates on Monday. And we're going to see, I think, other banks following suit. We'll cover that a bit later, perhaps. And then you've got those who are renting. So these are people who are not in the property owning stakes, but they're renting. And in fact, their confidence, although it's always tended to be lower than the average, has ticked up a little. And that's explained by the fact that some of them are now finding that the rentals that they have to pay are going down. So you can think of it as a positive for the renting sector, but of course it's a negative for the property investment sector. So this one chart shows you quite powerfully the interplay between the different categories of households that we have.
And that very much matches up with my friends that I'm speaking with in Melbourne and Sydney, saying that they're noticing a big uptick in listings. And what happens when there's more listings? Well, supply and demand, and now these renters have a lot more optionality. And that ties in with his next point about mortgage stress. So what do households do when they come to this point?
Yeah, so mortgage stress is another thing from our surveys. And this is essentially saying, for households who have a mortgage, are they handling the cash flow? So looking at money in and money out, not only for the mortgage, but overall, right? And on this chart, I've also overlaid a few other data points. For example, the household debt to income ratio, which is still very high. It's come back just a little bit, but it's still very high on any international basis you want to compare with. But the critical point here is that the mortgage stress has risen. It's now 31% of households are now registering as mortgage stress. In other words, they have issues with their cash flow. That's as high as it's ever been, and that's well over 1 million households now who are struggling with their mortgage repayments. It's never been this high, ever. And it's explained simply by wages being flat, static in real terms, cost of living continues to rise. The mortgages are still very large. In some cases, mortgage rates have moved up a little. And incomes are just not catching up with these costs of living rises. And they talk about electricity costs, they talk about healthcare costs, childcare costs, all those things. And they also, a few households here, highlighted also the changes to land taxes that have come through and the latest council rates that have come through as well. So there's a whole bunch of reasons why households are not very comfortable. So this is an early warning sign. 18 months to 2 years later, some of these stressed households will probably end up either being forced to sell or default.
And that's a pretty clear picture as to why there's a lot of people, such as ourselves, Martin, sort of waving a bit of a flag. And we don't want to be doomsday, sayers and whatnot, but it is important to tell people at home that household stress has never been higher, and that doesn't bode well for the economy and spending and jobs and all that down the road.
Well, you're spot on. It's that second order impact, right? So what happens is if households are in stress, they're hunkered down more, they spend less at the shops. They may raid their savings. And in fact, the next slide, which is the income and savings and consumption slide, really underscores this very well. The Reserve Bank data shows that households are continuing to consume more than can be directly supported by their income. And they're doing that by putting more on credit, particularly credit cards. There'll be a spike, I think, in the credit card data coming out next month, but also continue to raid their savings. And now the savings ratio is down yet again. Now, some people have claimed that that's a good thing because it shows that households are confident enough to raid their savings and spend more. I'm afraid that that's not what my surveys tell me, because the very people who are raiding their savings are people who are caught from a cash flow perspective. And you can't go on raiding your savings indefinitely. Eventually, they run out. So this is a leading indicator, again, of more stress in the system. And the only way this can be solved is if income were to start rising faster. But frankly, I can't see any way in the short term that's likely to happen.
And that's another great point about getting a detailed picture of what happened over that festive period once we get that data come out in the future, where people buying Christmas presents on credit cards. And if that's the case, they're probably going to bunker down even harder and pay down all that credit card debt in the first few months of the year.
Yeah, typically the January, February, March credit numbers go up and then down again. So we'll see whether that happens and whether the retail sales numbers stay as high as they were last month or whether they actually are lower. Some of the early data points that I'm seeing, though, from individual retailers suggest that perhaps that the Christmas festivities were not very powerful from a retail perspective, but we'll see in a month or so.
Yeah, and I know a lot of barbecues, we hear people talking about buying a lot online now as well, so I'm going to be interested to see how that affects things. But the next point here is house prices, and I want to start off on a positive note. My hometown of Launceston just recorded the highest growth around Australia of 11% annually, so there are pockets of growth, but the story that everything is going up is changing.
Yes, indeed. And, averaging doesn't tell you a huge amount, but this is the average data from the Reserve Bank. And it does show that all of the major metrics that come out from the various experts show that home prices have slid. The rate of slide is increasing in most states, but it does vary by location. It varies by type of property. In Sydney, on average, we're now about 10% down from peak to trough. But there are some postcodes in the western suburbs where it's more than 20%, and also some of the inner suburbs, particularly apartments, where it's down more than 20%. In Melbourne, we're also seeing the slide. The slide there is started later, but it's faster, and so they're 6 to 8% down. But again, there are pockets, particularly around the urban fringe, where prices are down 15 to 18%. Yeah. And if you go to Queensland, again, you find similar stories. They haven't dropped as far there, but again, there are pockets where things have got quite bad. And I was talking to somebody earlier on today up in Cairns who said that their prices are down 10% over the last year. And then if you look at Western Australia, well, the slide there has been going on for 7, 8, 9 years, and they're about 15% off their peaks. And Darwin is 25% off their peak from a number of years ago. So all of those are registering falls. Canberra is not at the moment. Canberra is pretty much holding its own. And then it's South Australia and it's Tasmania that are still moving up. Tasmania is continuing to move, but not as fast. So the rate of growth is beginning to slide a little. South Australia looks to me as though it's already peaked too. So it will be very interesting to see what happens in the autumn season when, in fact, more house price data comes through and when more sales are on again. But yeah, I think we have to assume that the overall trajectory is down. And remember, without wanting to be mean to Tasmania or South Australia, they are really small markets. We have 60% of property and 60% of mortgages in just 2 states, in Victoria and New South Wales. So in a way, the broader economy is going to be much more impacted by what happens in those 2 states compared with some of the more marginal players. But nevertheless, we do watch Tasmania and South Australia because they do seem to be holding their own a bit more currently. Interesting to see how that plays out ahead.
Yeah, and I don't think we do have the jobs or the industry to really justify house prices to accelerate in Tasmania at this stage. But this ties into this next point, and it's one of my favourites. It's household wealth, because I think this often can be a leading indicator for once people look at all the numbers, and then that affects their credit and confidence and things in the future.
Well, that's right. And so this is another RBA chart. It comes out from the chart pack each month. And what this shows you is the total net worth. So effectively what this is showing is, on average, all of the assets that households have, less all of the loans that they've got off one set against the other. And unusually now, since the early 2010s, we're seeing this beginning to fall. And that's because home prices are sliding. And you can see that in the dwellings line there. So it is actually dwellings that are creating the pain. The financial assets, things like stocks, haven't really registered because this data is up till the end, the end of the year. It's not yet showing the recent falls. So this is actually to November. Now, of course, we know that financial values are also off. So we've seen the stock market down, 10 or 15%, depending on precisely when you look at it. And so my expectation is that we are going to see continued falls in net wealth. Now, this is really important because we know that debts are still rising, and we know that now wealth is beginning to come off the top. That wealth effect, or the negative impact of lower wealth, has a significant impact on people's levels of confidence in what they're going to do. So one of the reasons why people are more likely to hunker down now than previously is because they're going to feel less wealthy. And of course, that interestingly plays into the debate now about the election in March or May. And, it looks to me as though we could well be having an election campaign in the teeth of a recession. So this is all very interesting ahead. But this slide is really, really important because it underscores the fact that wealth is falling. Although we're saying this is an average, right? So this is across all households and SMEs in Australia. Of course, some households have seen their net wealth drop significantly more. And in my surveys, I've seen some households who've lost more than 20% of their wealth in the last year. And that's a big deal because quite a few of them now are finding they're in negative equity. In other words, they don't have any value in their property. It's all owned by the bank, and that's a big deal.
Yeah, and this was something that's very close to my heart because it started my journey during the GFC when I'd look at my statement of my shares, and when people get that text message or that that note every quarter about how their super's performing, and people go, "Gee, I didn't realise that I had Australian shares and some exposure to housing, and my wealth has dropped, my super has dropped this much." So that's why I think that February-March period is going to be really important.
Yeah, you're absolutely right. And of course, superannuation, you're absolutely right, is leveraged into property. It's leveraged into the share market, international shares as well. So one of the things that people need to understand is that the superannuation balances that they hold are equally impacted by these broader movements in the market. And so, again, the wealth effect is spilling over not just housing, but it's more broadly as well. So again, it's a significant issue.
Yeah. Now, one of the things that can grow us out of this, well, there's probably two things. It's migration, which we might talk about more at a future date, but business investment. And I just look around and talking to the startups that we talk to in the blockchain space or in the tech space, it is so hard to get funded as a startup business in Australia. There's not a lot of business investment happening.
No, you're right. And this chart, again, is from the Reserve Bank. So business investment is actually slowing, and you can split businesses into the large multinational and large companies here. They're still able to get funding, but it's the small and medium enterprises who are really struggling. Many of them would be required to put their properties up for security to get lending. A lot of the banks are not just interested now, and interestingly, the construction sector is particularly hard hit, because, of course, many of those in the construction sector are now suddenly finding that the forward pipeline of work has gone off the boil, and they're having difficulty disposing of property that they are building or have built. So this is a really important leading indicator, and it's a sign, I think, that we are going to see GDP numbers get softer ahead. GDP is about half composed of consumer spending, and we've shown that consumption is under pressure. There's a significant contribution from the business sector, and then you've got a contribution from the government sector. In fact, it's the government sector that's the only sector that's growing at the moment in terms of infrastructure investment. So in a way, the reason the GDP number looks reasonably good is because the government's spending a lot of money. So it's a really fascinating phenomenon.
Yeah, and government spending is important, don't get us wrong, but it's not creating the next innovative business that's going to employ lots of people and get Australia competitive and all that sort of thing, really, is it?
Correct. So, in terms of creating future wealth for Australians and Australia, we need the broader economy to fire. And at the moment, unfortunately, the indicators are pointing the wrong way.
And the next one here is the interbank funding rates. And for those of people at home that aren't really familiar, banks tend to get more nervous lending each other money in times of stress.
Yeah, so this is basically giving you a flavour of what the banks are paying to get the funding that they need to be able to make the mortgage lending and the other types of lending between themselves, right? And this is an indicator, firstly, of the lack of confidence between the banks, and secondly, it's a flow-on effect from the higher international funding rates thanks to the Fed lifting rates in the US. And so the banks on average are sitting on about 20 to 25 basis points of margin compression. We mentioned the Bank of Queensland earlier on. They've actually now lifted their mortgage rates by on average 18 basis points on the total back book. So what that is doing is effectively giving a little bit of margin relief. My expectation is that because of these funding costs being extended now for a long period of time, we're going to see other banks essentially going the same way. So expect mortgage rates to rise, expect business lending to rise, despite the fact that they've still got these very, very attractive rates for new borrowers. And in fact, what this tells you is there's absolutely no loyalty bonus. In fact, it's the exact opposite. Once you've got a loan, it's open slather on putting your rates up. It's only those people who get new loans that may have the opportunity to be able to actually get a better rate. So again, this is another very important factor. And this funding pressure, I think, is going to stay with us into the months and years ahead as the Fed continues its path.
Yeah, and margin compression and interest rates is so critical for the next thing we want to talk about, and that's the financials, those stocks and so on.
Yeah, that's right. So this is an important slide too. This is effectively the ASX Financials Index, and this is a long-term view, right? So we've gone right back to the beginning of the 2000s, and what this shows you is that in recent times, in fact, since 2012, prices have gone up on average, and they've moved down and up. But we've now seen a considerable slide back down. So it's about 10 to 15. Some financial stocks are down 20%. In fact, some even more, like AMP. But this tells you that the forward expectation now is for lower returns from the finance sector. And that goes back to this issue of the margin compression. It goes back to the lower loan growth momentum. And as now we get the Royal Commission coming out in a month's time, and of course the Productivity Commission reported on the superannuation sector yesterday, we think there are more downward forces now on the finance sector. And wouldn't be surprised to see in the next round of data more defaults as well. So expect, I think, stock prices to continue to slide down. And the question ultimately becomes, what pricing power does the finance sector actually have? The major banks in particular, are they able to lift those mortgage rates and effectively recover some of those margins? At the moment, what they're doing is stealing margin from depositors, but that's only a certain amount they can do on that. Yeah. So that's one of the reasons why finance stocks are definitely on the slide at the moment.
Yeah, and even in Europe, we're seeing Deutsche Bank near record lows, and the US raised rates a lot more aggressively than a lot of people thought. And now, as you say, the bond rates in the US are higher than in Australia, which is just crazy. And there's going to be an attraction to suck up money into the US if they have those high rates, and just taking money out of the European banks or the Australian banks as well.
Yeah, and that's what the last slide really shows, right? So this is unusual. The fact is that bond rates are now higher in the US relative to Australia. Normally, it's the other way around. Normally, we attract investment into Australia because of the higher returns. But because of the fact that our cash rate is very low, because of the fact that our economy is not looking that flash relative to the US, and the fact that US rates are very high, effectively now, you can get a better return by investing in the US. So a lot of money that was offshore is now flowing back into the US. That's going to have a considerable impact on exchange rates. That's going to have a considerable impact on funding costs internationally. And this tells me that whilst the Reserve Bank may wish to cut rates later in the year, they may find it difficult to do so, because if they do, they're going to sacrifice the dollar even more. And in fact, we may need to see rates rise simply to try and offset this loss of relative bond returns compared with the US.
And I think there's never been a more important time to take an interest in all these things. And people are going to be attracted into other assets now, whether that's a bit of Bitcoin or gold and silver that you and John talk about a lot. We'll leave that up to you at home. But I think people are starting to ask a lot of hard questions.
Yeah, I think generally, if you stand back, what you can say is that we're coming into 2019 with a significant degree of uncertainty. That there is really lack of clarity on the geopolitical front, on the financial market front, on the political front here locally as well. And so, yes, I think prepare for the unexpected is what I say to people at the moment. It's going to be a bumpy ride. Buckle up. There will be opportunities, I think, through the year. But I suspect that by the end of the year, we will see the economy here in Australia looking less flash. I wouldn't be surprised to see interest rates lower, and I wouldn't be surprised to see credit off. But there are a whole bunch of questions and unknowns at the moment.
Yeah, and I was just shocked today when Fed Chairman Jerome Powell came out and said that he's worried about the debt in the US. So we've talked about this rosy sort of picture for the US comparatively to the rest of the world. And then even they come out and say, look, we're pretty worried. We don't really know what to do about all our debt. So where do people hide? Yeah.
Well, good point. And in fact, there was a very interesting thing that happened with Powell and Bernanke and Yellen. So, the three Fed chairs, and all of them said the biggest question we've got to deal with at the moment is the amount of debt and the systemic risk cross-country and cross-border. And they had to admit that whilst they've got some tools and levers available, they are all concerned about the level of risk in the system at the moment. And the fact is, globally, those risks are not, one, fully understood, and two, we don't yet have tools to be able to tackle. So that's why I think it's a very uncertain time at the moment.
That's probably a good place to leave it, Martin. We'll continue to talk about all these issues for people at home, and thanks so much for joining us again today.
Good to talk to you once again.
Cheers, guys.